us come to AS1. What is Accounting Standard 1? Disclosure of accounting policies. This is a very basic accounting standard which deals with one very specific issue, and that is called disclosure of accounting policies. What we will learn in this standard: the meaning of accounting policies, several areas in accounts where different accounting policies can be used, what are the points the company should keep in mind while selecting the accounting policies, and finally, what are the disclosure requirements relating to accounting policies. Okay. This standard AS1 is mandatory for all types of enterprises. All companies, all business enterprises which prepare financial statement in the form of balance sheet, P&L account, they will disclose about their accounting policies. That is what accounting policy they have followed while preparing and presenting the financial statement. AS1 deals with disclosure of accounting policies. In fact, you should underline the word significant accounting policies followed in preparing and presenting the financial statement. A company can have many accounting policies. Even the accounting policy can be how to capitalize an expenditure. Accounting policy can be what to do with traveling expenditure, what to do with salaries and wages. You are not supposed to give a disclosure of each and every accounting policy that you have followed. What you have to disclose? Significant accounting policies. Those accounting policies which will help the users of the financial statement to take an informed decision. Is it right? Overburdening the user of the financial statement is not desirable. Otherwise, instead of helping the users of financial statement, too much of detail may confuse the users of the financial statement. So only you have to disclose the significant accounting policies. Choice of appropriate accounting policy depends on the circumstances in which the enterprise operates. Is it right? Different enterprise may operate in different circumstances. Accordingly, they will choose the accounting policy. A software company and a manufacturing company may use different accounting policy for depreciation. Is it right? So therefore, what is right or what is wrong, that will depend on the type of enterprises. Okay. So therefore, there is not one size which fits all. According to situation, some differences in accounting policies can be there, but there should not be too much of variation in accounting policy followed by different enterprises. Otherwise, comparison will become very difficult. Okay. Indian accounting standards are little flexible as far as choice of accounting policies are considered. At several places, more than one options are given to you. Like for example, in case of depreciation accounting, you are given choice in case of WDV, straight line method or any other method which you want to follow, so that the depreciable amount gets written off over the useful life of the asset. In case of inventory, there are 2-3 choices given to you. You can follow FIFO or weighted average method. Is it right? So there must be more than one options given to you, but at the same time, too many options makes comparison difficult. So with that small introduction, now let us see First, the meaning of accounting policies. What do you mean by accounting policies? Accounting policies are sum of two things. Sum of two things. One, it is specific accounting principle. First is accounting policies are a specific accounting principle. Now, what do you mean by accounting principle? You can understand with the help of an example. Accounting principle is inventory should be valued at cost or NRV, whichever is lower. That is a principle, that at the year end, the inventory should be valued at cost or NRV, whichever is lower. That is a principle. Another principle is fixed assets should be depreciated over their useful life. Fixed assets should be depreciated over their useful life. That is an accounting principle. Okay. Current investment should be valued at cost or fair value, whichever is lower. That is an accounting principle. And method of applying those principles. Second thing is method of applying those principles. 1 plus 2. Accounting principle, fixed assets should be depreciated over their useful life. Method of applying those principles. SLM, WDV, sum of years digit method. These are the methods to apply those principles. FIFO, weighted average, are the methods to apply the principle of calculation of cost. Is it right? Specific accounting principle and method of applying those principles in preparing. First preparing means how to pass the entries, and then presenting, how to show them in the balance sheet and profit and loss account, in preparing and presentation of financial statement. So what are accounting policies? Accounting policies are a specific accounting principle and method of applying those principles in preparing and presentation of financial statement. What are the components of financial statement? Balance sheet, profit and loss account, cash flow statement, and notes to account. Example of accounting policies followed. In example of accounting policy followed, so accounting policies are decided for depreciation as to how the company is going to provide depreciation on the fixed asset. Fixed assets should be depreciated is a principle. SLM and WDV are the method to apply those principles. Inventory should be valued at cost or NRV, whichever is lower. Cost can be measured by FIFO method, weighted average method. In some countries, LIFO method is also permitted. In India, LIFO is not permitted for financial accounting purpose. Weighted average is permitted. Treatment of goodwill. How should goodwill be amortized? Is it right? Whether over 3 years or 5 years. How to do accounting of retirement benefit. These are some examples. Valuation of investment. More than one principle is followed. Investment can be current investment. Investment can be long-term investment. Investment can be valued at cost or fair value. In case of fixed asset, the principle will be which expenditure should be capitalized and which expenditure should be charged to P&L account. That is a principle. You have to decide that this is what we need to capitalize, this is what we need to charge to P&L account. Treatment of expenditure during construction period, whether it should be capitalized or charged to P&L account. In fact, most of the accounting standards deal with different types of accounting policies which companies can follow. So even if you forget the example, remember you have fixed asset, investment, goodwill, retirement benefit, borrowing cost, leases, hire purchase. These are the areas where different accounting policies are followed. This standard is disclosure of accounting policies. Why there is a need to disclose accounting policies? You will see in annual report of every company, without any exception, that there is a paragraph which says note on significant accounting policies. Why every company disclose their significant accounting policies? One, it helps us to understand the performance better. It helps us to understand the financial position better. You can understand the balance sheet and P&L account better if you also know the accounting policy followed by the enterprise. Otherwise, sometimes the company can manipulate their financial position and financial performance. Suppose they do not provide depreciation at all. But if you write in the accounting policy, company does not provide depreciation, it will get reflected in the financial statement. You can understand it better. Difference in inventory valuation method can change the profit and loss account figure. Difference in treatment of goodwill can affect your profit and loss account figure. So it helps in understanding the financial statement better. It helps an individual or an investor to compare the financial statement of one enterprise over a period of time. Is it right? If last year you had followed FIFA and this year if you have followed weighted average, comparison will be difficult. But if you follow AS1, disclose your accounting policy for both years, then different years' financial statement can be compared. Not only that, it helps to compare the financial statement of different enterprises. If you see one company showing higher profit, don't jump to conclusion that that company has performed better. Okay. If you know about their financial accounting policies, you can compare them better. Suppose A and B are two companies. Profit before depreciation and tax is 100. Less depreciation. One follows straight line method. One follows WDV method. So their profit before tax will be 90, 75. Less tax at the rate of 30%. 27, 20.5. So this company's profit after tax is 63. This company's profit after tax is 52.5. A person who does not know the difference in the accounting policy they have followed will prima facie jump to the conclusion that A is performing better than B. But the truth is something else. Both have performed equally well, because the performance will be reflected by PBDT, profit before depreciation and tax. The rest is all the difference in accounting policy. If B had also followed the same accounting policy, it would have provided 10. Its profit after tax will also be same 63. Unless you knew this, you may make a wrong conclusion about the performance of these two companies. Is it right? So therefore, the investors keep the accounting policy notes of different companies when they are comparing to see the impact of difference in accounting policies. Disclosure of accounting policy is also required by the law. Companies Act makes it mandatory that you must follow accounting standards issued by ICI. AS1 is issued by ICI. So therefore, indirectly, the disclosure of accounting policy is backed by the law also. Okay. Next is point number 5 in your book, last line. The view presented in the financial statement can be significantly affected by the accounting policies. Let the user of the financial statement know that these are the accounting policies we have followed. Then he will decide whether this company is worth investing or not. The profit and loss account and the financial position can be significantly affected by difference in accounting policy followed. Okay. And therefore, although you may not appreciate it, but this is one of the most important accounting standards which is practically applicable. Objective for selection of accounting policies. What are the objective for selecting accounting policies? First is underline the second sentence in your book. to present a true and fair view of the financial position and to present a true and fair view of the financial performance. Is it right? Appropriate accounting policy should be chosen. Appropriate accounting policy should be chosen so that balance sheet shows a true and fair financial position and profit and loss account shows a true and fair profitability position. Profitability position is required to be known to understand the performance of a period. Financial position is required to be known so that you will get to know what is the worth of this business as on a given date. What are the assets and liabilities of a company at a given point of time? Okay. Now next paragraph number 7. Consideration for selection of accounting policy. Tick mark for a theory question. Consideration for selection of accounting policies. While choosing accounting policies, some care you should take. Care number 1. Who has to choose the accounting policy? The management. Every management decides which accounting policy they will follow for different types of transaction. Accounting standard says keep 3 things in mind when you choose the accounting policy. One is concept of prudence. Concept of prudence means anticipated profit should not be recognized, but anticipated losses can be recognized. Profits are not anticipated but recognized when they are actually realized. But provision is made for all known liabilities and losses even though the amount cannot be determined with certainty. Is it right? So example of profit should not be anticipated. Sales order received. Suppose you have received a sales order. You are a businessman, your customer has placed an order on 29th March 2014 to deliver 100 units at 100 rupees. तो सेल्स ऑर्डर सिर्फ आपको मिला है, आपने गुड्स डिलीवर किया 3 मई 2014 को, तो आप सेल्स की एंट्री 29 मार्च को पास करेंगे या 3 अप्रैल को पास करेंगे? 3 मई को पास करेंगे. करेक्ट. Which means you will not recognize sales on 29th March, only on receiving a sales order. Although there is an anticipated profit here, because had you passed the entry for sales on 29th March, you would have booked profit on that day if sales include profit. So anticipated gains are not recognized. Suppose you have filed a case against your competitor. Your competitor has copied your design. Okay, you have designed a mobile phone which has been copied by the competitor. अब आपने case file कर दिया है. You expect to get rupees 5 crore as damages for the suit filed. Will you recognize income of 5 crore rupees today? No, you will recognize it when they will be actually realized. When you will be actually realizing. So anticipated gains are not recognized. Suppose you are holding inventory on the balance sheet date. Your cost was 100 rupees, but their market price have increased to 150 rupees. Will you recognize a profit of 50 rupees? You will not. Anticipated profits are not recognized. You know that tomorrow I am going to sell it for 150 rupees, so I will make a profit of 50, but you will not recognize it today. Okay. Known losses and known expenses are provided for, even though the amount may not be known with certainty. Example, provision for bad debt. Okay, provision for bad debt which you have learned is nothing but a concept of prudence. You know that out of sales made in a year, based on your past experience, 2%, 3% of the customers don't pay. So before the actual bad debt loss happens, we make provision for bad debt loss. Inventory is valued at cost or NRV, whichever is lower. Whichever is lower. Why? Cost on the balance sheet date is 100. Market price is 90. We will recognize the inventory value at 90, which means before selling the inventory only, we have recognized a loss of 10 rupees. Okay. Current investment. Current investment is valued at cost or fair value, whichever is lower. Whichever is lower. So if the fair value of the current investment goes down, we recognize the loss even before selling the investment. Okay. All provisions under AS 29, Accounting Standard 29 deals with provisions. So provisions created under AS 29, Accounting Standard 29, provisions, contingent liability and contingent asset. Those provisions are nothing but application of concept of prudence only. You are creating provision for all known liabilities even though the amount may not be certain. That is concept of prudence. Concept of prudence should not be overstressed also. Concept of prudence should not be overstressed. Yani ki suppose we are preparing the financial statement of 2013-14. Our financial is 2013-14. You are going to suffer a loss in 2014-15. Will you make provision for a loss which will arise in 2014-15? No. Concept of prudence should not be overstressed also. ऐसा भी नहीं होना चाहिए कि अगले 2-4 साल का लॉस 20 साल आपने recognize कर लिया. That is also not advisable. Okay. Overstatement of profit or understatement of profit, both are not correct. Next is example on prudence. In your book, inventory is valued at cost or NRV, whichever is lower. Because if NRV goes down, we recognize the loss. But if NRV goes up, we do not recognize the gain. And all provisions under AS 29 are examples of concept of prudence. Second thing, substance over form. Substance over form. That is, while recording a transaction in the books of account, we should see the economic reality behind the transaction, truth behind the transaction, not just the form in which the transaction appear in front of us. Is it right? A transaction may appear in one form, but its actual economic reality may be different. Like for example, finance lease. Assets given on lease under finance lease. In the form it appears that one party has given the asset on rent and the other party is paying the rental. That is, in form it appears like a leasing arrangement. Okay, कि एक पार्टी रेंट दे रहा है, दूसरी पार्टी ने एसेट को रेंट पे दिया है. But in substance it is not a leasing arrangement. In substance it is a financing arrangement. It is one party has sold the asset to other party and the other party is paying the value of the assets in installment. So while recording the finance lease, we do not record it as a rent received or rent paid. Rather, we record it like a sale and purchase transaction. And the payment received from the lessee is recorded as a payment towards the amount due and not as a rental income. I'll give you a simple example. Hire purchase transaction. In hire purchase transaction, legal ownership is not transferred till the last installment is paid. So in the eyes of law, the purchaser is not the owner. But in the eyes of an accountant, he is an owner in substance. because for all purposes, the hire purchaser is the owner. All risk and reward is transferred to the owner. So therefore, in hire purchase, the moment you purchase the asset, you pass an entry, asset account debit to hire vendor account. If you go by the form, the entry is wrong because you are not the owner. So you have no right to capitalize an asset for which you are not the owner. But in substance, you are the owner. In substance, you are the owner. So that is an example of substance over form. Economic reality over legality. Okay. Should be given importance. Correct? Substance over form. तो ये एक बहुत इंपॉर्टेंट है, ध्यान में रखना, लीगल ओनरशिप इज नॉट नेसेसरी फॉर कैपिटलाइजेशन ऑफ एन एसेट. इफ यू हैव बिकम ओनर इन सब्सटेंस, you have become owner in substance if all risk and reward belongs to you. All important risk and reward belongs to you. You have become owner in substance even though you may not be the legal owner. So example of substance over form, one is, see this example which appears in your exam also quite a number of times. The rights and the interest in immovable property is transferred. That is agreement to sell to buyer, but legal documentation like sale deed for the sale is yet to be completed. The transaction will be recorded as sale. Now those who have not understood, when a immovable property is transferred, yani land or building, okay, on 1st March 2014, agreement to sale has been done, signed. Actual legal ownership is transferred when sale deed is registered, which took place on 1st May 2014. बीच में year ending date आ गया 31st March. How will the transaction be recorded in the books of the buyer and seller of this immovable property? It will be recorded as a sale and purchase, because in substance the ownership has been transferred, even though in the eyes of law the ownership may not have been transferred. 1st April को एक आदमी ने पेमेंट कर दिया, दूसरे पार्टी ने पोजीशन दे दिया, आप वहां जाके मालिक की तरह रहने लग गए, लेकिन सिर्फ ये जो सेल डीड है ये अगली साल रजिस्टर हुआ. तो जो पेमेंट किया है एक पार्टी ने दूसरी पार्टी को, उसे एडवांस दिखाना है या पेमेंट टुवर्ड्स परचेज ऑफ प्रॉपर्टी दिखाना है? यस, पेमेंट टुवर्ड्स परचेज ऑफ प्रॉपर्टी, सब्सटेंस ओवर फॉर्म. देन हायर परचेज, फाइनेंस लीज. ओके, फाइनेंस लीज अकाउंटिंग स्टैंडर्ड 19, राइट डाउन, रेफर अकाउंटिंग स्टैंडर्ड 19. हायर परचेज ट्रांजेक्शन ऑल्सो रेफर अकाउंटिंग स्टैंडर्ड 19. What about substance over form? You have to see again. If in substance movable property has also been transferred like hire purchase, then also you can record the transfer. In the previous example, the student is asking, is the concept of prudence violated? The concept of prudence is not violated there, because in substance the ownership has been transferred. It's only the formalities which are pending. Payment is done, ownership is transferred, everything has been agreed, settled. But sometimes suppose court is closed, registration office is closed, or due to some technical problem some delays are there, but for all practical purpose the ownership has been transferred. You can record the sales. Both hire purchase and finance lease are covered by Accounting Standard 19, Group 2 of IPCC course and in CA final course. Question number 1 and 2 are your homework. Come to page number 3. Materiality. What is materiality? Any accounting information is material if it can influence the decision maker. Accounting Standard 1 says companies should disclose in its financial statement all material items. Here the word material means all important items. Now what is important? Which can influence the decision of the user of the financial statement. An accounting information, the knowledge of which may influence the decision of the users of the financial statement. If I know this information, I may take this decision. If I don't know this information, I could have taken another decision. What is material and what is not material is a little subjective concept. Because what is important for one enterprise may not be important for another enterprise. What may be important for one user may not be important for another user. Therefore, companies while choosing accounting policies have to be very careful. They should try from their side that all important information are disclosed in the financial statement. At the same time, they should not overburden the users with too much of details also. Example on materiality. Sales of a company is suppose 4,25,000. Repairs and maintenance expenses are 45,000 rupees. In this case, 45,000 is a relatively material expense as compared to a sales figure of 4,25,000. Okay, but suppose the sales figure is 50 crore rupees and then repairs and maintenance incurred are 45,000. Then a separate disclosure of repairs and maintenance may not make much difference. Is it right? Some examples of materiality we will be discussing. Understand? Suppose you have to write printing and stationery item. In P&L account, generally we write like this: to printing and stationery. Do we write like this in P&L account debit side? To pens, to pencil, to rubber, to sharpener, to scale, to highlighter, to stapler, to pins. Wait. User of a financial statement is not interested in such details. That is why what we do, we put all these expenses under one heading: printing and stationery. That is enough. The external users may not be very keen on understanding how much money was used for buying highlighter, pen, pencil, stapler, cardboard boxes, etc. Okay. Or for example, we write electrical fittings when we prepare fixed asset note. Now in this electrical fitting, I don't start writing so much bulbs were used, tube lights were used, wires was used, this and that. Instead of understanding the P&L account and balance sheet, you'll get further confused. Okay. This is materiality. Sometimes materiality is defined in the Companies Act itself. Materiality is defined in the Act itself. Like for example, if any item as per revised schedule 6 is 1% of turnover or rupees 1 lakh, whichever is higher, will be shown separately. Will be shown separately. 1% of turnover or rupees 1 lakh, whichever is higher. If any amount individually exceed that figure, will be shown separately. Payment made to auditors will be shown separately. Even if you have paid 1,000 rupees and company's turnover is 1 crore rupees, even 1,000 payment made to auditors is to be shown separately. Depreciation and amortization is shown separately. So some items are specifically asked to be shown separately. No noise. Now, come to next heading, paragraph 8, fundamental accounting assumptions. Accounting standard 1 says, there are certain fundamental accounting assumptions which are assumed to have been followed while preparing and presenting the financial statement. They are so fundamental, so basic, that there is no need to even disclose that the company has followed this fundamental accounting assumption. The disclosure would be required if these are not followed. They are so basic that every user of the financial statement is going to assume that they have been followed. तो अलग से लिखना नहीं है that the company follows the same accounting policy year after year. A consistency is a fundamental accounting assumption. Going concern is a fundamental accounting assumption. You don't have to write our company is a going concern. We have no intention of winding up in the next year. So dear investor, please rest assured, we will continue for another 12 months. इसकी लिखने की जरूरत नहीं है. कब लिखना है? When going concern is no longer valid. Okay, when you think company may not survive for another 12 months from the balance sheet date, then inform him so that he can sell his investment on time and come out of that company. Okay. Usually not specifically stated because their acceptance and use are assumed. Disclosure is necessary only if they are not followed. So what are these three fundamental accounting assumptions as per accounting standard 1? One is called going concern, second is consistency, and third is accrual. Going concern means it is assumed by the user of the financial statement that company is going to continue its operations for the foreseeable future. Company is going to continue its operation for the foreseeable future. What does that mean? It means indirectly company is not going to wind up, close down, liquidate its operations in the foreseeable future. What is foreseeable future? Foreseeable future means at least for a period of 12 months. Although not specified clearly, but at some other places institute have interpreted foreseeable future as यानी अगर बैलेंस शीट की डेट से अगले 12 मंथ्स में कंपनी को बंद नहीं होना है तो गोइंग कंसर्न है. ये डिस्क्लोजर बहुत इंपॉर्टेंट है क्योंकि अगर कंपनी बंद होने वाली है तो इन्वेस्टर को पहले से ही बता दो तो समय रहते वो अपने शेयर्स बेच के बाहर निकल सकता है. इज इट राइट? सो दैट इज गोइंग कंसर्न अजम्पशन. गोइंग कंसर्न अजम्पशन का एक और ये भी है, मतलब द एंटिटी हैज नाइदर द इंटेंशन nor the necessity of liquidation or of curtailing materially the scale of the operation. What do you mean by curtailing materially the scale of operation? They are not going to substantially reduce the scale of operation because again it is as good as going to wind up only. ठीक है? How does it affect your accounting? It affects the accounting. If the company is not a going concern, then we do not follow historical cost accounting. What is historical cost accounting? That assets and liabilities are generally recorded at historical cost, the amount at which they were acquired. Is it right? But the moment the going concern assumption is no longer valid, we will not follow historical cost concept. Then we will restate the assets at the realizable value. And in that case, we may have to record some losses also. And this is also a hint given to the users of the financial statement that we may not continue in the future so that they can take the necessary decision which they want. In auditing also there is a standard called going concern. So that you will study in auditing syllabus, going concern. What has to be exactly done when going concern is not followed? is given in detail in auditing standard. In AS1, you have to make a disclosure that ours is no longer a going concern. इसके आगे क्या करना है? This is not a part of AS1. It is a part of auditing standard. Because then you have to restate the balance sheet, assets and liabilities figure as per as per auditing standard. More about that in your auditing batch. Now, second fundamental accounting assumption is consistency. Consistency is very important in accounting. Otherwise, the financial statement will lose their reliability. Nobody would trust the financial statement if you don't follow the same accounting policy every year. So consistency principle means during the current year, the accounting policies followed are same as that of previous year. Company has followed the same accounting policy which it had followed in the previous year. No change in accounting policy is assumed if nothing is informed to the user of the financial statement. अगर आपने इस साल वही अकाउंटिंग पॉलिसी फॉलो की है जो पिछले साल आपने फॉलो की थी, तो अलग से लिखने की जरूरत नहीं है कि हमारी कंपनी ने इस साल सेम अकाउंटिंग पॉलिसी फॉलो की. इट इज अज्यूम्ड, इट इज सो बेसिक. ओके. एंड व्हाट इज थर्ड वन? Accrual. Accrual concept is again very fundamental, which means income is recognized when they are earned, not necessarily when they are received. Expenditure is recognized when they are incurred, not necessarily when they are paid. Is it right? Simple example will be credit sale. Entry is passed in this year. Maybe the collection will materialize in the next year. Credit purchases, all expenses outstanding, etc. are recognized because they have been either incurred or they have been earned. Understood? Yes. What do you mean by earned? That is, now you have got the right to receive the amount. If you have only received a sales order, it is not earned. But when you have sold the good with transfer of the ownership of the goods, then you have earned the right to receive the money. Then you will recognize the sales. Okay. Employee has rendered the service. Employee has rendered the service. You are, as per the contract, you are going to pay him bonus. Bonus will be paid to him in the next year after the year is over. But you will make a provision for bonus payable because the rendering of service means the liability has been incurred. Even better example is making provision for gratuity. With the employee, the condition is that on your retirement you will be given gratuity. When will gratuity be paid? On retirement. When he will retire after 25 to 30 years. But are we going to recognize the gratuity expense when he retires, or we are going to recognize gratuity expense every year? Every year. Because the liability has been incurring. It's only the payment which is getting postponed. Okay. That is accrual. Accounting policies should be followed consistently year after year. Otherwise, the trust and faith in financial statement would be lost. Okay. Reliability would be lost. If you keep changing accounting policy every year, then users will not trust your P&L account and balance sheet figure. They will think that they have changed it. So we don't know what is right, what is wrong. So prima facie, we should not change the accounting policy. But does it mean that we can never change the accounting policy? Standards cannot be so rigid. Standards cannot be so rigid that you can never change your accounting policy, because business circumstances may change. Economic environment may change. Legal environment may change. Keeping that in mind, under any of the three situations, the accounting policy may be changed. Example, change is required to comply with law, statute. Let us say Companies Act has been amended. And now suppose, for example only, not actually, for example purpose, the new Companies Act says every company will follow WDV method of depreciation. For example sake only, aisa hai nahi. So what will happen now? All those companies which were following SLM or any other method will have to compulsorily shift to WDV. Because now this is a requirement of the law. Okay. So sometimes the law is amended and as a result the companies have to revise their accounting policy. It is allowed to comply with either a new accounting standard or a change in existing accounting standard. Like for example, long back LIFO method was allowed to be used for valuation of inventory. Long back, 15 years back. But then accounting standard 2 was revised. LIFO is no longer a permissible method of inventory valuation. So those companies which were following LIFO will have to change their accounting policy and will have to follow FIFO or weighted average method. Is it right? Earlier for accounting standard 7 purpose, completed construction contract method was permitted. Which method? Completed construction contract method. That is, income is recognized only once the construction work is complete. Not anymore. Now they say that you have to follow only proportionate completion method. Which method? Proportionate completion method. Completed contract method is not allowed. So those companies which were following completed contract method will have to now shift to proportionate completion method. That is, you will recognize the income and expense when the work is proportionately completed, not when it is fully completed. Earlier there was no accounting standard on deferred taxes. Now you have to follow deferred tax accounting. Is it right? Accounting standard on retirement benefit has been revised, A.S.Foundation. So you have to now calculate the retirement benefit liability as per new standard, which is different from old standard. So therefore you can change the accounting policy. And one more flexibility is given to the enterprises. Change would result into a more appropriate presentation. This third one is nothing but it is a power given to the management. If the management believes that using this new accounting policy will reflect the financial statement better, will reflect the performance better, more appropriate presentation can be done, then they can change the accounting policy. Okay? But this third point is something which has been misused also by many companies. In order to bring a desired change in profit, just to increase or decrease their profit in a particular manner, some companies simply change their accounting policy in the name of better presentation. Okay. So what will you do when there is a change in accounting policy in a year? When there is a change in accounting policy in that year, disclose this fact that you have changed the accounting policy, so that the user of the financial statement, when he'll compare last year with this year, he can understand the difference better. You will say this year we have followed WDV method, previous year we had followed straight line method. Not only that, you have to also quantify the effect of change in accounting policy. Is it right? Had you followed SLM method this year also, what would have been the profit and loss account figure? ठीक है? So quantify. पहला तो disclose करो कि हमने अकाउंटिंग पॉलिसी चेंज की है, पुराने को और नए को दोनों को लिखो, पहले ये था अभी ये है. और दूसरा, पहली पॉलिसी फॉलो करते तो प्रॉफिट क्या होता और नई पॉलिसी फॉलो करने से प्रॉफिट कितना हुआ है, और नई पॉलिसी की वजह से प्रॉफिट एंड लॉस अकाउंट पे या बैलेंस शीट पे उसका कितना फाइनेंशियल इंपैक्ट आया है. ओके, दैट हैज टू बी डिस्क्लोज्ड. If you cannot quantify the effect of change in accounting policy, if you cannot quantify, then that fact should be disclosed. that although there is a change in accounting policy, but it cannot be quantified. Example of change in accounting policy, which is followed by many companies: SLM to WDV or WDV to SLM, FIFO to weighted average to FIFO. Keep in mind, you have to disclose the change in accounting policy and its impact in P&L account and balance sheet. Now come to the most important paragraph of AS1, and that is what this standard was actually aiming at: disclosure of accounting policy. So what are the key points to be kept in mind? The key points to be kept in mind while disclosing the accounting policy is all significant accounting policies adopted in preparing and presenting financial statement should be disclosed at one place. So in the notes to account, the companies disclose all their accounting policies at one place. Suppose you disclose two accounting policy in balance sheet, two accounting policy in P&L account, two accounting policy in notes to account, two in director's report, two in auditor's report. आप बोलेंगे सारी अकाउंटिंग पॉलिसी आ गई है एनुअल रिपोर्ट में, इधर उधर कहीं ना कहीं ढूंढ लो. It is not in compliance with AS1. AS1 wants to make the user happy. Give him all accounting policy at one place. उसको भटकना नहीं पड़ना चाहिए, दो यहाँ एक वहां. Is it right? सब एक जगह उसको एक प्लेट में दे दो जितनी अकाउंटिंग पॉलिसी, ताकि उसको बेचारे को ऐसे घूम घूम के नहीं खाना पड़े, एक जगह बैठ के उसको पूरा परोस देना है. हाँ जी. A change in accounting policy should also be disclosed in the year of change. Second basic point, change should be disclosed. Third, disclosure of significant accounting policies will form part of the financial statement. So it is a part of your financial statement only. It's not something different from financial statement. And since it is a part of financial statement, the management as well as the auditor has a duty to ensure that it is properly presented. The management as well as the auditor has a duty to ensure that it is properly presented because it's a part of financial statement. If fundamental accounting assumptions are followed, as per AS1, specific disclosure is not required. If fundamental accounting assumptions are not followed, then that fact should be disclosed. Next is disclosure of an accounting policy, however, cannot remedy an inappropriate treatment of a transaction. What does that mean? If suppose you have followed a wrong accounting policy, wrong accounting principle, and you have gladly disclosed it, that does not justify use of a wrong accounting principle. You cannot write in your notes to account and get away with it. Company follows LIFO method for inventory valuation. So you are honest that you have disclosed your accounting policy, LIFO method of inventory valuation. But in India, LIFO method is not a permitted method. LIFO method is not a permitted method. So therefore, even if you have disclosed that we have followed LIFO method, it will not prevent the management from answering the shareholders that why a wrong accounting policy was followed. Auditor will have to qualify the audit report. Is it right? Auditor will write a comment about the use of wrong accounting principle for valuation of inventory, even though it is officially disclosed in the notes to account. You cannot write happily, company does not provide depreciation. Not providing depreciation is also an accounting policy, and you have disclosed it also honestly, but that is a wrong accounting principle. Mere disclosure does not justify a wrong accounting policy. उसके जो इफेक्ट्स है वो तो होंगे ही. इफेक्ट ये है, नंबर वन, द डायरेक्टर्स विल हैव टू एक्सप्लेन in director's report why a wrong accounting policy was followed and the financial effect of that. Auditor will have to qualify the audit report. Is it right that company's financial statements does not reflect the true and fair view. ये ऑडिटर की भी ड्यूटी है और डायरेक्टर्स की भी ड्यूटी है. ओके, नाउ जस्ट आंसर दिस क्वेश्चन. कैन सेम टाइप ऑफ इन्वेंट्री at two different factories be valued by applying two different accounting policies? Same, underline same word. Can same type of inventory, page number 2.5, question number 1, read the answer. Is it allowed? This is a very tricky question, and ICA has got one expert advisory committee. Expert advisory committee's role is to answer such difficult queries, because this was not answered in either AS1 or AS2. Same inventory, kept in this location, kept in this location, kept in Pune, kept in Aurangabad. Inventory is same. Can we follow different accounting policy? No. तुमको उठा के यहां रख दूंगा, तुम्हारी वैल्यू थोड़ी चेंज हो जाएगी. तुम तो वही हो. अब इस पेन को आप यहां रखिए तो इसकी वैल्यू 100 रुपए है, उसे उठा के यहां रख देंगे तो 100 ही होनी चाहिए. अलग अलग मेथड यूज करेंगे तो इसकी वैल्यू चेंज हो गई ना. तो इंस्टीट्यूट का मानना है कि जब इन्वेंट्री सेम है, अब ये फर्क नहीं पड़ता कि आपने उसे यहां रखा हो या उठा के यहां रख दिया हो, उसकी वैल्यू तो सेम होनी चाहिए. इज इट राइट? So let me read the answer whether ICI is also given the same answer. The same type of inventory at two different places cannot be valued. Underline cannot be valued at two different, by applying two different accounting policies. And their reasoning is very sound, because just because you keep it at two different places, their value will not change. Obviously, if the transportation costs are different, storage costs are different, those differences will be taken care of. Not just because it is kept at two different places, assuming other things are constant, their value must also be same. Okay, now next question number 2. Only on the screen you will read, think, answer and forget. The finished goods inventory is valued on prime cost and on principle of market value, whichever is lower. The cost included the cost of raw material, packing material, direct production, labor expenses and excise duty is applicable on finished goods. Comment. Is the accounting policy of valuing finished goods is right? This answer you can give even better if you have studied AS2. Since you are in IPCC, somewhere before that you have studied AS2 inventory valuation. So identify what is the mistake in this accounting policy. Accounting standard 2 says inventory should be valued at prime cost plus production overhead. Prime cost plus production overhead. But this company is valuing inventory on the basis of prime cost. Production overheads have not been considered in calculating the cost of inventory. And therefore, the accounting policy followed by the company is not correct. Is it right? Okay, one more question for you. Question number 3 in your book, page 2.5. Fixed assets are stated at cost of acquisition. Very good. Or construction, including attributable interest and finance costs till such assets are put to use, less specific grant received. So whether this accounting policy is right? The accounting policy is right. Correct entry. Why? Here we have to apply two standards, AS10 and AS12. AS10 says, even AS16 also, sorry, borrowing cost. As per AS10, all costs incurred in bringing a fixed asset to its present location and condition should be capitalized. As per AS16, if an asset is a qualifying asset, then interest cost must be capitalized. वो भी आपने सही किया है. As per AS12, if any grant is received specifically related to a fixed asset, grant from government is received specifically related to a fixed asset, then that should be deducted from the cost of the fixed asset. Because then to that extent the fixed asset has been financed by the government. ठीक है? So the answer is the company's accounting treatment is right. All acquisition and construction costs should be capitalized. Borrowing and other financial costs can be capitalized if it is going to comply with conditions given in AS16. And as per AS12, government grants specifically received in connection with a fixed asset can be deducted from the cost of fixed asset. Okay. AS1 is over. Today's batch is also over.